of the REC to the special REC meeting number 427, held today, the 6th of May, via Microsoft Teams. And let me just take this opportunity to apologize to the members of the public that were ready for us at 1300. We had to deal with some of the governance matters before we stream the meeting. On that note, members, we do have a proposed agenda, and the agenda that we have is one just agenda that is for the open session of our meeting as advertised. It is the item on municipal and private distributor tariffs application for the financial year 2026-27. Members, by show of hand, can I get an indication if you do adopt the agenda as presented? Thank you, Mr. Majola. Mr. Mkhize, also. Thank you, Mr. Mkhize. I do support as well. On that note,
through you, I only support the 13 applications, not the additional 23. Thank you. When us supporting the agenda adoption.
Okay, I think what was advertised initially was that the 13, but I think let me just adjust that to the members for the benefit of the members of the public. We only have 13 agenda items that are going to be considered today, and we'll have another special meeting tomorrow for the consideration of the other items. On that note, members, yes, the consideration for the agenda is on the 13 items. On that note, I believe members do adopt the agenda as amended, but we are considering the 30. And thank you for that. And we then move on to item 4, declaration of interest. Any verbal declaration from the members? By show of hand? I don't see any hand from the members. On that note, I'll take it that the members have no verbal declaration, but implore on them to really complete the forms that have been provided by the secretary for the meeting, to complete them and submit them to her, and as well as the members of NESA personnel to do the same and submit them to the secretary of the meeting. On that note, we'll proceed with our special REC meeting number 427 with one item that is open for the public, and I think I've read it into the record. It is on the electricity regulation, particularly the municipal and private distributor tariff applications for the financial year 2026-27. And before I proceed, let me just introduce the members of the REC, just for the benefit of those that have not been part of our meetings. My name is Nomalanga Stole. I'm the CEO at NESA and the chairperson of the REC. I sit on a number of subcommittees and committees of the energy regulator and the energy regulator itself. And I would want to introduce the next member of this particular committee, which is the REC, Mr. Mkhize, who is the chairperson of the Petroleum Pipelines Subcommittee, which is an industry regulated by the energy regulator. He sits as a member of the REC and also sits on other subcommittees and committees of the energy regulator and the energy regulator itself. Mr. Mkhize, do you want to greet the attendees?
Good afternoon, Chairperson, fellow members of the subcommittee, management and staff of NERSA, as well as the members of the public that are following us through the various live streaming platforms. Thank you very much, ma'am.
Thank you, Mr. Mkhize. I'll move on to the next member, which is Ms. Nofundo Maseti, who is a member of this particular subcommittee, the REC. She chairs the pipe gas subcommittee, and she sits on other subcommittees and committees of the energy regulator and the energy regulator itself. Ms. Maseti, do you want to greet the attendees?
Thank you, Chairperson. Good morning, good afternoon to you and the members of the REC, staff of NERSA, as well as the members of the public following today's deliberations of this meeting. Thank you.
Thank you, Ms. Masetti. I'll move on to our last member, which is Mr. Willie Brod Majola, who is the member or the chairperson of the Electricity Regulation Subcommittee, and he's a member as well of the REC, and he sits on other subcommittees and committees of the Energy Regulator and the Energy Regulator itself. Babu Majola, do you want to greet the attendees?
Good afternoon, Chair. Good afternoon to the members. Also, good afternoon to the entire team at NERSA, as well as a very good afternoon to the members of the public that have joined us. Thank you.
Thank you, Mr. Majola, and I think I've touched on the other agenda items. We then move on to the agenda item that has been set for this particular open session of our meeting, which is an item on municipal and private municipal and private distributors that are licensed in terms of their tariff application that they've submitted to the regulator for the financial year of 2026-27. Mr. Matebula, do you want to do your introductory notes or statement rather, and also guide us in terms of the process that needs to be followed by the committee? Over to you, sir.
Chair, good afternoon, and to you, and good afternoon to the members of the Regulatory Committee, my NERSA colleagues, as well as those who are following us on the live stream. Chair, we again have brought today 13 applications from our municipal licensed distributors as well as private distributors. Chair, this is a continuation out of the 176 tariff applications that we have received to date. 43 of those have been processed in the last meetings. And today, Chair, we would like to have an opportunity to present these 13 applications for consideration by the members. And Chair, I must indicate that this project has attracted in excess of 2,000 stakeholder comments. Chair, I must indicate that on the submission document, under from the page 11 of 435, we have indicated the number of comments that we received linked to specific municipalities. And Chair, as we present to the committee, we will be indicating specific municipalities which we received comments and what those comments were and how we have responded to those. But I must indicate, Chair, that in that number that I indicated, about 678 were coming from private individuals all over the country who took the opportunity, Chair, to really express their views on issues relating to electricity and electricity tariffs. So they were not specifically linked to any municipality, but they were also dealing with the issue of affordability of electricity and other electricity related matters. So Chair, if you allow, I would request that we proceed to present these 13 applications and allow members, Chair, to indicate and their views on whether they support and where we need to improve. And we appreciate, Chair, all the guidance that we have received in the past two engagements that we had. We have tried to include and enhance our submissions to include and cater for those comments and recommendations that were made by the members. However, Chair, we believe that there may be more areas that we need to address and have the opportunity to address those. Chair, that's all from my side, and we can proceed to consider the applications. Thank you.
Thank you very much, Mr. Matebula. On that note, we'll proceed with the first application, which is from Drakenstein Municipality. Ms. Matumbu, over to you, ma'am.
Thank you, Chair. Afternoon, members, colleagues, and the public. Drakenstein is a municipality situated in the Western Cape, apologies, and has applied for an average tariff increase of 6.30%, and it is supported by a revised cost of supply study. The municipality indicated that the reason for the revision is that the municipality wanted to introduce a new small domestic time of use tariff, which would provide residential customers with the opportunity to manage their consumption patterns and costs. The chairperson, please note that this is a resubmission. This particular municipality served on the REC of 30 April and was withdrawn for further enhancement on the surplus section. If we look at the application was submitted with this council resolution and proof that the municipality has conducted its customer consultation, and no correspondence regarding objections received by the municipality was submitted to NERSA. On the NERSA side, the application was published on the NERSA website, and we received no objections. From a financial and technical perspective, the municipality reported a surplus or recorded a surplus of 17.9% and low energy losses of 7.7%. As per the audited 2024-2025 financials. The cost of supply indicates that the municipality's required revenue is 2.1 billion to achieve full cost reflectivity. And the cost structure is largely driven by bulk purchases, which account for about 76% of total costs, while operating expenditure makes up the remainder of the 24%. And this chairperson includes a surplus of 12%. To ensure that the surplus is reasonable and was not overstated, the 12% surplus was tested against the NERSA cost of supply framework, and which provides a tolerable range of between 10 and 20. And it was found that the surplus is also in line with the EPP position policy 1. In addition, the surplus was assessed against key risk factors, which included revenue collection risks such as non-payment and bad debts, operational risk, which includes energy losses and aging infrastructure, and the need to maintain financial sustainability of the electricity function. Chairperson, the municipality has no ESCOM areas and therefore no interest charged and no NMD penalties. Therefore, this ensures that customers are not burdened with avoidable costs. With the applied margin being within the tolerable range, it is considered appropriate and justified in the circumstances because the municipality demonstrates relatively stable operational performance, manageable energy losses, and no material financing risks such as ESCOM areas or penalties charged. Furthermore, affordability consideration and the need to mitigate tariff shocks support a more moderate margin. Accordingly, we found the 12% surplus appropriate and strikes an appropriate balance between ensuring financial sustainability and protecting customers, and therefore it is reasonable. Chairperson, the cost of supply also showed a level of cross subsidies where over recovering customers are subsidizing under recovering customers, and the municipality is encouraged to develop a cross subsidization framework to objectively address the cross-subsidization issues in a transparent and fair manner. To reach cost reflectivity, the cost of supply indicated that the municipality should increase its tariffs by 8.6. However, the municipality elected to implement a lower increase of 6.30, adopting a phased approach. This approach reflects a deliberate balancing of financial stability and affordability consideration, particularly given the socio-economic context of its customers. Chairperson, it is therefore recommended that the REC approve the tariffs that are based on the COS report as for implementation by the municipality with effect from 1 July 2026. The cost of supply report be submitted by the municipality be noted, and the municipality is further required to submit a report accounting for all costs that have been noted in this cost of supply to enable the energy regulator to perform its independent verification and audit processes. Thank you, Chair.
Thank you, Ms. Matumbu. Members, any questions, issues of clarity that you may need on this particular submission or points of enhancement that you may have? Mr. Mkiza, I see your hand is up. You may proceed, sir.
Thanks, Chairperson. Thanks, Madam Matumbu, for the presentation. Under 1.5, you talk of the municipal resolution and proof of having conducted customer consultations. If we can just finish it off by or augment it by indicating if there were any comments received, and if yes, what were the responses, if any. And then I hope you would also update 1.7, noting the date of today's meeting. Also, I think that under 2.4.2, we can include the fact that public participation processes were conducted by both municipalities and the energy regulator. Then, if that is the case, from our side, I also appeal that you ensure that the table on revenue requirement components, you make it more clearer, more readable. And I think under 4.4.18, make a proper reference because it is still table 4. That growth of 29% in terms of depreciation, if you may just provide maybe some reason. I mean, with that, could be that maybe they put additional assets in the intervening period. If we just allude to that. And I think the 12% is just falling within the range, and under 4.1.14, not referred to as benchmarking as such, but just simply falling within the range. Otherwise, I am supportive. But sometimes when the increase is less than what ERSA increase is, I'm not so sure of the implications thereof in terms of sustainability going forward. But I'm noting what is on page 37 of 435. Other than that, but thank you, Chair.
Thank you for that input, Mr. Mkiza. Ms. Masiti.
Thank you, Chairperson. Thank you, Ms. Matumbu, for the presentation. I would like to start off with paragraph 4.4 in the way that the revenue requirement was determined. And this is a critical step in the process in terms of looking at the COS framework, because it is the first step where the regulator needs to determine how much revenue is required, so that moving from there, we can do the functionalization and cost classification and allocate the cost so that we get to the tariff. I am surprised that on paragraph 4.4.1.1, that there is a statement that says that there is no need for the regulatory asset base because we're using a cost plus methodology. Section 18.7 states clearly that this underlying cost that we must allow, they contain OPEX as well as the CAPEX, and that the CAPEX needs to be assessed and approved by the regulator. That is in terms of section 18.7, which is the key requirement of the kind of exercise that we need to do. I am surprised then that we can put in our documents regulatory asset base that it is not required because it's a cost plus. How are we then going to determine the revenue required for this municipality? Because that revenue required will have a component of the operational expenses and will also have a component of the capital expenditure. Then it will have the profit margin. That's what is in our framework. Can we clarify this aspect here? What do we mean by this? And how did we then do the verification for the revenue that is required? If we say that the part that deals with the RAB should not be considered, which is in the framework and in the EPP. The second thing that I would like to touch on, the last bullet point of paragraph 4.4.1.1, then you read that with paragraph 3.2, those two paragraphs make reference to the surplus. 3.2 does not explain how the surplus has been determined. Yet in paragraph 4.4.1, we link it to reasonable surplus margin, which is probably something that we talk about, that reasonable profit margin. Now, how did we deal with that? Especially to then verify whether that profit margin is commensurate with the risk, because we returned the submission, particularly on that aspect. And at least we should have explained that during the introduction, how that was addressed, given that we returned it. And number two, that issue of surplus, it should also talk to the issue of the cost of capital, the risk related to that. And it doesn't talk to that, because that's what we should also be taking into consideration. Lastly, Chair, the surplus issue is also dealt with in the MFMA. And I had already requested that, because it is not specifically mentioned in EPP as well as in the ERA, at least let's make sure that when we deal with it, we comply with the two regulatory framework, but read it in harmony, even when the MFMA deals with it, for financial sustainability of the municipality. Thank you.
Thank you, Ms. Rossetti. And Ms. Matumbu, do you want to come in?
Thank you, Chair. With regards to Mr. Mkhize's comments, those are noted, and they will be enhanced in the RFD. And thank you, sir. With regards to Ms. Masetti's comments, the cost plus methodology, Ms. Masetti, does not take into account the RAB. So in terms of CAPEX, it uses depreciation. The revenue requirement does not include CAPEX as a direct line item. Instead, CAPEX is reflected indirectly through depreciation. That is how we dealt with that mem, and we ensured that hence we indicated that the surplus, we tested it against the approved tolerable range as per the cost of supply framework, which is approved by NERSA, to ensure that whatever surplus that the municipality is applying, it's within those tolerable range, to ensure that it is sustainable. Thank you. I'm not sure if that will cover your questions, ma'am. Thanks.
Chair, if I can maybe add.
Yes, please, Mr. Mat.
Yeah, so I think the issue of REB, the way it has been put on the document, maybe it is misplaced. But the attempt was obviously to distinguish between the cost plus methodology and the return on or rate of return methodology. It was to try and differentiate the two. But I think the part where we are explicitly saying no regulatory asset base, probably it is not entirely correct, but especially because when you deal with depreciation of assets, it is regulated assets. So that is where the regulatory asset base will still come in. Chair, on the part of the surplus and its reasonability, Chair, considering that this municipality has intentionally requested for a lower tariff increase, its financial sustainability, it's hinged on the surplus that it's currently provided for this municipality. I think Mr. Mkhize had indicated how will the municipality cater for its cost with a tariff that is lower than that of the bulk supply. So also understanding that there may be other sources where the municipality is able to supply its customers besides Eskom, but that on its own, it introduces a risk to the municipality, and that risk is absorbed by this surplus factor of 12%. I just wanted to add on that, Chair. Thanks. I'm not sure if maybe Ms. Mabinya, as part of the team member, would like to add before you take comments from members. Thanks.
Thank you. I'm also mindful of the time. I see Mr. Mkhize is addressed. Ms. Masetti, you may come in. You've got 1 minute to do that.
Chairperson, my question is not answered. I appreciate the clarity that Mr. Matebula provided regarding that problematic paragraph 4.4.1.1. But the issue of the surplus, which I am saying, it was the reason for returning this submission, is still not dealt with. And I would like to also put it on record that it is incorrect that we cannot consider the asset value, because it is clearly stated in the very same document that we are looking at, the policy position, which states clearly how to determine the reasonable return. Well, one thing, and then the second one being the profit margin commensurate with the risk based on the appropriate asset value. So, and I've tried to guide, Chair, by saying that when we determine the revenue is made up of the OPEX as well as the CAPEX. So the cost of capital, and also to ensure that the surplus will cover the refurbishment plans of the municipality and the risk associated with the cost of capital, not necessarily the work. The work would have been on the rate of return. But here, the cost of capital aspect for the surplus, I'm guiding again and I'm mentioning specific issues. That is not dealt with to demonstrate how that was taken into account. And I think this is sufficient guidance on those specific issues that are not spoken to in relation to the chosen methodology. Thank you.
Thank you. Tate Matabula or Ms. Matumbu, any comments before we move on to the recommendations?
As I've mentioned, thank you, Chair. As I've mentioned that under the cost plus methodology, CAPEX is reflected indirectly through depreciation. So when considering the surplus, we only looked at OPEX and depreciation and ensured that these components are efficient, reasonable, and prudently incurred. And we further evaluated this surplus against the regulatory ranges and policy guidance. And we also don't want let me just end it there, ma'am. Thank you. Maybe my other colleagues can come in and assist. Thank you.
Okay, thanks. I think maybe it's a process issue or application issue of the process that is followed. I think Ms. Masetti indicated that revenue, you take the OPEX and CAPEX, and you're saying in terms of the cost plus methodology, you have indicated or taken through the issue of the depreciation and looked, or rather CAPEX and depreciation, and look at the efficiency thereof. So probably it is the process of analyzing the application that may be sort of not aligned. But for me, what is important is for you to indicate that at the end it does give the results that are expected on the application. Mr. Mkuze, your hand is up.
Thank you very much, Chairperson. I think it's just important we posted it, making this here. As a country, sometimes we fail there's failing expressing ourselves in the sense that you sometimes we use cannot and is not and may not, alternative when we mean different things. For my understanding, the issue of the RAB and the CAPEX has been already addressed of those 2 pages, and it's a matter of being able to articulate here in this that in the methodology that see considered in terms of the CAPEX at because here you've got a cost plus methodology. You want to be in the same vein like when you've got a return on assets, where you must then have an ROA that is with this. But in terms of that depreciation, it is considered. And I think that Matebula and the team, all these issues that we've already spoken at length about, and try to lay a foundation thereon. Let's have those difficulties the case, this issue, these are the matters, this is how it's been addressed. Because in other submissions, this has been very well articulated. And I think that just transpose it from there to this submission. So we can then be able to progress. Thank you.
Thank you, Mr. Mkize. I do not see any other hand. I think for me, what is important or that I'm drawing from this particular application we may be taking into account all the issues, but using different methods. And therefore, then, for as long as it does get us to exactly what needs to be considered, it is appropriate. And on that note, I think there were recommendations that were read into the record on page 19. And oh, sorry, I saw Ms. Masiti's hand is up. And Ms. Masit, you may come in.
Thank you, Chairperson. Chairperson, I would not like to delay your meeting. I am dissenting on the recommendations, and the issues that I'm raising are not in general. They are issues that I am engaging specifically on what is in the document and the calculation. The calculation of the surplus must demonstrate how it has been done and how we arrived at the amount, the figure, and how we tested for reasonability. And thirdly, linking it with financial sustainability. That's what we need to do. And by doing that, we have done the harmony that we are required to do for the MFMA surplus related issue that is mentioned there, for what the profit margin is expected in the EPP, and linked with the ERA, those three together. So I'm raising that in that regard. I don't want to make comments in documents in general terms. I'm engaging on specifics and what is before us. On that basis, Chairperson, as also stated on the chart, that has not been demonstrated. I'm happy to dissent based on the statement that I've made. Thank you, Chair.
Noted, Ms. Masetti, but we were not yet at the voting stage, but we'll note that. And members, the recommendations are on page 19, noting Ms. Masetti's reasons for dissenting or not supporting the decision. By show of hand, can I get an indication that you support the recommendations with the enhancements that are needed for this particular application? Thank you, Mr. Majola. I do support, and thank you, Mr. Mkize, noting the reasons for Ms. Masetti for not supporting, or rather her dissenting decision on this particular application. May we then move on to the next one? Members, I'm just mindful of the time. If we can just state issues that needs to be addressed, and as well as in a concise manner, and also the responses be done in the same way. We are on item 2, which is Hasekwa Municipality, and it's yours again, Ms. Matumbu. Over to you, ma'am.
Thank you once again, Chair. Hasekwa is situated in the Western Cape and is applied for a 7.01%, supported by a revised cost of supply study. The municipality used a cost plus methodology when conducting the study, and they indicated that the reason for the revision of their cost of supply is that their previous study had exceeded its 5-year validity period. Chairperson, we should please also note that this is also a resubmission, and it served on the meeting of the 30 April and was withdrawn for further enhancement on the surplus section. The application, Chairperson, was received on the 31st of March, and the municipality submitted its council resolution and proof of having conducted customer consultation together with the application, and no correspondence regarding objections received by the municipality was submitted to NERSA. NERSA published the application on the website, and we received one objection. The stakeholder raised concerns that the cost of supply did not adequately justify the proposed increase in basic charges, particularly given that the inflation and CPI are lower than the ESCOM tariff increase. Chairperson, the stakeholder comment was analyzed, and this was discussed on table 7 on page 82 of 435, and responded to the customer comment by saying that the regulator takes into account all charges, all fixed charges and cost drivers that the municipality submits to us, and ensure that only efficiently and prudently incurred charges are then translated to tariffs, and that such tariff, such basic charges or fixed charges cannot merely be benchmarked against the CPI, and that tariff setting must be balanced with cost reflectivity, affordability, and economic efficiency. From a financial and technical perspective, Chairperson, the municipality recorded a surplus of approximately 11% and energy losses of 9%. And this shows that the municipality is financially sustainable and operates its electricity business efficiently. Chairperson, the cost of supply study indicates that the revenue required for the municipality to reach cost reflectivity is 298 million, and the cost structure is largely driven by bulk purchases, which accounts to 76% of the total costs, while the operational costs make up the remainder, of which is 24%, and this includes a surplus of 8%. Chairperson, the surplus was tested against the NERSA COS framework, and also assessed in line with the key risk factors, which include revenue, risk collection such as non-payment and bad debt, operational risk including energy losses and aging infrastructure, and the need to maintain financial sustainability of the electricity function. The municipality has no ESCOM areas and no interest charged and no NMD penalties. And even though the surplus is below that tolerable range, it is considered appropriate. And Chairperson, the cost of supply further showed that there are cross-subsidization, where over-recovering customers are subsidizing under-recovering customers, and the municipality indicated that it will implement a phased-in transition approach, which includes gradual alignment of tariffs towards cost-reflective levels and a reduction of the cross-subsidies. And the municipality is encouraged to develop a cross-subsidization framework to objectively address cross-subsidization issues in a transparent and fair manner. The cost of supply indicated that a 5.3% increase in its tariff is required for the municipality to reach full cost reflexivity. However, the municipality applied for a uniform 7.01% across all its customer categories. The municipality opted for this approach to meet its financial sustainability, which includes its ability to milk with ESCOM bulk supply obligation, and also it's maintaining its tariff structure, and it also took into consideration affordability of its customers, looking at the current economic conditions. So the recommendation is that the tariffs that are based on the cost of supply be approved as recommended for implementation by the municipality from 1 July 2026. The cost of supply submitted be noted, and the municipality is required to submit a report accounting for all the costs that have been noted in this cost of supply to enable the energy regulator to perform its independent verification and audit processes. Thank you, Chair.
Thank you, Ms. Matumbu. Members, any questions, issues of clarity, or points of enhancements in terms of the analysis of this particular application? Please do raise your hand so that you can make your contribution. Thank you. Ms. Basiti. Thank you, Chair. Chairperson, the municipality has no ESCOM areas and no interest charged and no NMD penalties. And the municipality applied for a uniform 7.01% across all its customer categories. The municipality has applied for a uniform 7.01% across all its customer categories. And even though the surplus is below that tolerable range, it is considered appropriate. And Chairperson, the cost of supply further indicates that the
Thank you to Ms. Matumbo. Ms. Matumbo, as you have noted, the objection on the cost of supply, a certain cost that, or at least the cost of supply in terms of the accuracy of the cost of supply, of which cost of supply influences the tariff that is required and the decision that we are required to make. May you please indicate what verification have you done on those costs, specific costs that form part of the objection to the cost of supply, so that we avoid issues of taking a tariff decision when the cost that are used for the tariff decision are costs that are based on the challenged or the cost of supply study that is being challenged and objected to. That's the first thing, those specific costs. And just to clarify, then how did you verify those to make sure that at least the decision of the regulator is insulated in that respect? And then the second thing, if you can just deal with I can see on table 4, for instance, where you deal with the wires and also the bulk and so forth. If you can just indicate the relationship between the surplus itself with also the capital related cost. Thank you.
Thank you, Ms. Masuti. Ms. Matumbo, do you want to come?
Thank you, Chair. To respond to Ms. Maseti's questions, sorry. The fixed charges, ma'am, we verified them when we looked at the customer related costs and not just the energy and demand costs. We looked at the ESCOM invoices, the trial balance, and which we made sure that the municipality derived all those customer costs from their metering, meter reading, and ensured that their network connections were correctly installed and in light with also taking into account that they have energy losses which are low. So we looked into to that, and we also compared the fixed charges to the other costs drivers in the other components of the tariffs, ma'am, to ensure that they are not overly inflated or ensure that they are efficient. And in terms of the I'm sorry, ma'am, I do you mind please repeating your second question?
Table 4. Ms. Maseti, if you can repeat that, I think it was on table 4, the relationship with the cost of capital that you raised. Table 4, I'm just trying to get to the page. You may come in. I see your hand is up.
Thank you, Chair. I just wanted to assist in simplifying for her. What I wanted you to assist with is just on the surplus. Remember that the surplus must be linked to the profit margin. Remember, there are two options in the EPP. For the rate of return, you can calculate a reasonable return, and then you use the WACC to check the risk related. Now, if it's the cost plus, there is you must use the profit margin, which is step 1 as articulated in the COS framework that we are using. And in addition to the fact that the other option is the cost of capital. Now I'm asking for you to then link that surplus to the cost of capital, if you can make reference to table 4, so that we can also see how you have done it and relate it to the importance of ensuring financial sustainability and reasonableness. Those are the 2 things. Thank you.
Oh, okay, thank you, ma'am. The surplus took into account the depreciation, which you as highlighted in table 4 for both the wires and the retail, and the depreciation acts as the proxy for the capital expenditure, ma'am. So the surplus took into account depreciation, and we verified the surplus, or we tested the surplus against the cost of supply tolerable range to ensure that it is not overstated.
Chair,
Thank
if I
you.
can maybe just add around the reasonability of the 8% that ASEQA is being afforded in terms of surplus. Chair, if you look at ASEQA's OPEX, we see that there is obviously that increase, and on its bulk purchase is amounting to about 78% of the revenue required, and the other 22% it's for OPEX. So if you look at the past 2 years, there's been an increase in the OPEX, and the current required increase is below the bulk approved increase, and that in itself, Chair, it introduces a risk. So that the surplus of ASEQA continues to drop, as seen on, I think there's a table I just need to refer it to, but if you will see that there is a decrease in the surplus in the past 2 years, and ASEQA continues to absorb the increase that comes with the bulk purchases, and it has also demonstrated that there has been an increase in its OPEX, and that in itself, Chair, continues to impact on its. It will depend on its surplus to be able to remain financially sustainable. The last thing that I wanted to talk to, which is on the same table that we are talking about, there is also the cost of losses that has been accounted for, Chair, that is indicated on that table. So that as well, Chair, will continue to erode on the surplus that ASEQA is currently being afforded, over and above the fact that it will not be having a pass-through cost to its customers based on its bulk purchase prices. Thanks, Chair.
Thank you, Ms. Masitebula. Ms. Masita, are you answered?
Yes, Chairperson, I'm answered by the clarity from Mr. Matebula, but there's additional points on the chart which to guide all of the colleagues going forward as they are busy. They are going to present, but I would like to just caution that Ms. Matumbo must not mention depreciation, because you can only do that when you deal with the asset value, please. So she can't talk about 2 now. She's completely confused and make wrong statements. The team must guide senior people so that we take away those things from the record. Thank you.
Noted. Thank you. And I just trust that the team is having access to the chat and note the input that have been made that are for enhancements. On that note, The recommendations have been read into the record. They are on page 62. Members, by show of hand, can I get an indication that you do support the recommendations with the enhancements that have been made? By show of hand. And thank you, Mr. Majola, Ms. Masetti, Mr. Mkize, and I do support. We then move on to Getwana Municipality, Ndate Ralufe. Over to you.
Thank you, Chairperson. Apologies, I was speaking to a muted mic. Thank you once more, Chairperson, and good afternoon to members, everyone in the meeting, including the public as well. Chairperson, Getwana Municipality is a municipality situated in Free State that is supplying electricity to 4,339 customers with 2,821 indigents. In Getwana local municipality, Chairperson have supplied a new cost of supply, which followed a cost plus method. And the main reason they indicated was to resolve the tariff discrepancies within the electricity business, as well as to cater for the changes emanating from the RTP. And the municipality indicated that they've consulted with its customers, and we have also done consultation from NERSA as well. And then, Chairperson, with regards to financial performance of this municipality, the municipality have recorded a deficit of 20.29%, coming from a deficit of 6.58%. And the reason for this deficit or rather this deficit was mainly driven by the ESCOM interest. The municipality is owing ESCOM an interest of 28.5 million. And it has been dealt with, and we'll explain to it as we go on. And on energy losses, Chairperson, the municipality have improved on energy losses from 22.72 to 9.87, which is an improvement from double digit to a single digit. Chairperson, and just to give a clarity on the energy losses, despite a single digit, the municipality from the lost revenue, or rather lost revenue from those losses, amounts to 32.2 million of its revenue. And on the cost of supply, Chairperson, the municipality have applied for a revenue requirement of 183 million. And from that revenue requirement, which is applied for, we have done an adjustment, Chairperson, which is on table 6 of the submission, where we have done an adjustment, which was mainly on the ESCOM interest, and the adjustment resulted into an adjusted revenue requirement of 149.2 million. And the adjustment was done on OPEX, and the adjustment also affected the surplus from 5.7 million to 4.5 million. And Chairperson, also on the rate design, or rather, yes, on the rate design, the adjustment was done from the results of the COS of 12.1%, and then it was revised further down to 11.4%. And Chairperson, looking at the schedules of tariffs, the municipality opted to apply for a 10.8% of the municipality opted to apply for 10.8%, and on its operating expenditure, on its tariffs. And then we found it worth that it be approved as such, because it's even lower than the rate design, even the adjusted rate design. And the municipality indicated that it is due to affordability of customers. And Chairperson, just before I forget, on the issue of cross-subsidization, this municipality, it's highly subsidized by domestic customers conventional, which was one of the reasons for the new COS, and it's also another customer category that is subsidizing is agriculture, large power users, and some commercial customers. And Chairperson, I would like to usher you to the recommendations emanating from this submission. We recommend that the tariffs that are based on the cost of supply are approved as recommended in the tariff analysis section for implementation by the municipality with effect from the 1st of July 2026. Secondly, we recommend that the cost of supply report submitted by the municipality be noted. Thirdly, we recommend that the municipality is required to submit a report accounting for all the costs that have been noted on its cost of supply study to enable the regulator to perform its independent verification or audit process. And finally, we recommend that the municipality is required to submit a quarterly report, but this was emanating from general recommendations. The municipality have reflected the issue about the issue about improved energy losses. Chairperson, we can then take the fourth one to request the municipality to also, NSA can also follow up on the ESCOM interest to see how the municipality is progressing for its sound financial position. Chairperson, let me stop there. Thank you.
Ndate Rolofe, can you just clarify your recommendations? Because what you are saying and what is written on page 118 is quite different. Just tell us what you are amending so that the members can be put to a vote to understand exactly what you are recommending. Because what you're saying verbally and what is written here, it's quite different. Can you repeat your recommendations on 118?
Okay, thank you, Chairperson. I would like to withdraw recommendation number 4. And for the record, we recommend that the tariffs that are based on the cost of supply report are approved as recommended in the tariff analysis section for implementation by the municipality with effect from 1 July 2026. And we also recommend that the cost of supply report submitted by the municipality be noted. And we also recommend that the municipality is required to submit a report accounting for all the costs that have been noted in the cost of supply study to enable the regulator to perform its independent verification or audit process by the 31st of January. Chairperson, I withdraw recommendation number 4, and apologies for that, Chairperson. Thank you.
Noted. Thank you. Members, on that note, with the recommendations that have been amended on page 118, can I get an indication that you support this particular application? Unless if members do have questions to raise. I think I'm taking up the vote. Thank you, Ms. Maseti, Mr.
No,
Mkize,
Chairperson, on the questions.
Okay. Let's just hold on the voting, members. Let's take Ms. Maseti's point of clarity or question. Over to you, ma'am.
Thank you, Chair. Thank you, Mr. Ralufe. My question is on the statement around this statement. I think we need to deal with it carefully. This statement on the tariff that is based on the cost of supply studies, especially given the high energy losses and taking other costs that are that are inefficient there. So if Mr. Rarupe can indicate sort of the, I know that he said we will still do the verification, but I think on a reasonable basis, just so that we can show the reasonableness on these tariffs, if you can indicate, how we how did we ensure that we insulate consumers from paying cost that they should not be paying for, that found themselves found their way to the tariffs, first of all, and also just the emphasis on the importance of the revenue improvement and to deal with the energy losses, which are actually inefficient and within the municipality's control. If I can get just clarification on that. Thank you, Chair.
Thank you. There's another hand from Mr. Mkize. Mr. Ralufe, I would like you to take them both. And Mr. Mkize?
Thanks, Chairperson, and thanks, Mr. Raluf, for the presentation. I'm just confused with regard to 4. Recommendation 4, because I thought recommendation 4 remains relevant if I'm reading the same here in terms of the energy losses reduction program reports. I'm not so sure whether what's the reason for totally eliminating it, because it remains relevant. Secondly, I think it's important when we're talking of public consultations that we also go further. I think I've said this, and I don't want to repeat again to the subsequent presenters, that we also reflect on whether we did receive comments and what happened with those comments, because we should be very clear that we don't do same just to tick boxes, but we truly consider them. So if you may reflect, and the same applies with the municipality side of things. And then you talk of eliminating the other inefficient cost, like the losses above what is prescribed in the framework. I just would like to know, was this post the application, or it was part of the process of applying, such that what they applied for at the end of the day ended up being the same with what you are recommending? Because I was just a bit confused with regard to that. Thank you.
Thank you, Mr. Mkize. And Tate Rulefe?
Chairperson, before I respond, Mr. Mkize, may you please clarify the last question? I don't know if I understood it properly.
The question is simply that if you had removed certain losses that you deemed to be within the control of the municipality, what they applied for would then not be necessarily the same with what you approve, because those figures would not be the same. Just want to get clarity around that, whether they applied as part of the process incorporating what we had already removed or not. I do understand.
Okay, Mr. Mkize, I will attempt to answer your question, and if not understood, then I believe you may make a follow-up. Maybe to start with Ms. Masedi's question on energy losses. Ms. Masedi, the energy losses, or rather, not address you straightly, but members, the energy losses have deteriorated from 23-24 to 24-25. They are now at 9.87, which is an improvement for that matter. And then regarding the prudency on costs, yes, I've made mention of the cost of supply that reflected a proposed average increase of 12.1%. And after the revision, after eliminating all the imprudent costs, and then it got adjusted to 11.4%. However, the municipality, considering the affordability of the customers, then applied for a 10.8%. Now considering that what was supposed to be allowed as an increase is 11.4%, we therefore recommended that we give the municipality what they've approved for, which is 10.8%. That is below what have been what the COS has reflected. And the issue about the report on energy losses, the reason to withdraw that recommendation was that now the energy losses have improved from 22.72 to 9.87%. Now it's on a single digit, but we are happy to further request an energy losses report, even though it's at a single digit. On the issue of consultation, and apologies, Mr. Mkize, I couldn't, I just forgot to mention it from the beginning that from NERSA's side pertaining Nketwana local municipality, we didn't receive any comments. And the municipality from its side, it just gave a proof of an attendance register. So that is where the consultation process have gone up to. I don't know if I've answered everything effectively. Thanks, Chairperson.
Thank you, Dr. Ralufo. Members, any questions, issues of clarity? Or further, or rather follow-ups on the questions you've raised?
I'm covered regarding the percentages as well as the issue of the energy losses, and that then because the figure that was ultimately requested by the municipality is below that, even which incorporates the elimination of those losses that are deemed to be within their purview to deal with. So it's covered in a way the second question that I raised. Thank you.
Okay, thank you very much, Mr. Mkize. Ms. Maseti, are you covered?
Yes, Chairperson, I am covered.
Thank you. Mr. Majola, your hand was up. I don't know, it was for voting and it went down. If it was for voting, I would like to request members that we go and recommend, or rather consider the recommendations that are on page 118, and noting the input or improvements that members have highlighted to the analyst. And on that note, members, can I, by show of hand, get an indication that you support the recommendations with those enhancements or issues of clarity that you would like to see in the RFD? Thank you, Mr. Majola, Mr. Mkize, and Ms. Maseti. And on that note, we then move on to the licensee that have not amended their COS. And we will start with Beaufort West Municipality, and it will be presented by Ms. Botha. Over to you, ma'am.
Thank you, Chairperson. Good afternoon to you. Greetings to members, colleagues, and the public at large. So today, Chairperson, I'll be taking you through 6 tariff applications, starting with Beaufort West. With this in mind, I'd like to request that perhaps I take a deep dive on this one, and then just quickly glide over the subsequent submissions because they will be back to back. Obviously, having provided a bit of context in how I have assessed the applications, if that's in order with you, Chairperson.
That is fine, as long as you can also cover the issues that have been raised by members in the previous sitting. Over to you, ma'am. Do what is comfortable for you, but address all the other issues raised in the previous application. You may start.
I'll do my best. Thanks, Chair. Beaufort West submitted its application on the 31st of March, along with supporting information, including the Municipal Council's resolution approving the tariff increase, as well as some proof of its public consultation process. In compliance with PAJA, NERSA also followed its own public participation process and published the applications as and the licensees' existing cost of supply study. These were published on the NERSA website and all other various platforms on the same day for comments by the 21st of April. We can confirm at this point that no comments were received by the closing date. Then in terms of the application, Beaufort West is situated in the rural outskirts of the Western Cape, and the municipality supplies an economically constrained district with low industrial base. They have applied for an average tariff increase of 8.5% for this current 26-27 financial year. This is versus the 11.32% implemented in 25-26. The licensee conducted its 5-year cost of supply study, which is currently valid until the financial year 2029-2030. And it was assessed for compliance with the cost of supply methodology, and it passed all the checks and balances. In determining the tariffs this current year, the determination of the tariffs are principle on the legal basis established under the ERA, Section 15, which provides that the energy regulator must enable efficient licenses to recover the full cost of licensed activities, as well as to allow for a reasonable return proportionate to a risk. And complementary to this is the EPP Policy Position 1, which stipulates that the revenue requirement for a regulated licensee must be set at a level that covers the full cost of production, including a reasonable risk-adjusted margin or return. The municipality's financial performance on its own is anchored on the revenue surplus or deficit principle, and this is in accordance with the Municipal Finance Management Act, which is MFMA for short. So in establishing the municipality's financial performance, the surplus margin therefore becomes the reasonable rate that municipalities derive from their revenue, net all the capital and operating costs, in order to act as a buffer against several risks that are proportionate to service delivery. The surplus principle, therefore, closely aligns with the cost-plus methodology as defined in the COS framework. This surplus margin, therefore, seeks to cover risks ranging from any revenue shortfalls or unforeseen and unavoidable infrastructure disasters that the municipality might face. And such risks include, say, financial and liquidity risks. And this includes instances where actual revenue collected falls below the budgeted. And also, one of the important risks associated with the buffer that is aligned with the surplus is the operational and service delivery risk, which then allows for the municipality to continue providing their service and maintain the service levels despite any economic changes. So with this context, the municipality has an asset base in approximation of 461 million rands, and the depreciation amounts to 28 million as at June 2025. However, for rate setting purposes, within the same period, the municipality made a provision of roughly 3 million rands in depreciation, and they are forecasting about 4 million for the current period of 2026-27 financial year. This is a normal practice in a cash-based accounting where the municipality only focuses on the actual cash needed to maintain its service delivery obligations. In terms of its performance, Table 3 on Grim Stamp page 150 of 435, Chairperson, illustrates that in the 24-25 financial year, Beaufort West operated at a surplus margin of 2.32%, which represents a material downturn from a 4% in the previous period. Its energy losses slightly optimized from 20% to 17%. And both these measures of performance suggest a weakening overall position and highlighting increased vulnerability to the financial and operational risks for Beaufort West. The major contributing factor of this has been that the licensee's expenditure outpaced its sales revenue growth during the reporting period. Looking at the revenue, we can see that it grew by 11.9%, whereas the expenditure grew by 16.9%. So this gap alone is an obvious mismatch, and that's apart from technical losses that are attributed to several factors, including the bridging of electricity, as well as some affluent customers that are slowly migrating to other alternative sources of energy, as reported by the municipality. The conclusion on this is to suggest maybe to the municipality to mitigate the risk of long-term sustainability, to apply strong financial controls and curb its expenditure. Then table 4 demonstrates the revenue impact of the energy losses, where the results are simply revealing that under the current scenario of 17% losses, the operating surplus realized is about 3 million rands, and this translates to the current surplus margin of 2%. And in contrary to that, if the losses were to be reduced to 12%, all else being equal, the estimated revenue that could be recovered is an additional 5 million, which entails losses that are kept, and which includes the PET losses that are attributed to lack of collection, because the municipality's collection rate is about 85%, which means it's not only the losses are not only related to technical losses, but also financial losses. And it's not included in this RFD, Chair, but I've done a further step of energy loss reduction scenario in the event that the losses are kept at 6%. And the result in that is that the municipality would recover an additional 10 million rands, equivalent to a surplus margin of 9.7%, should it keep its losses at around 6%. And then in assessing the application itself, I carried out an analysis to determine the merits and the impact of the application based upon various economic factors in the context of the end users and the licensee. In so doing, I considered both scenarios if the application gets approved and if it's not approved. And I had to consider impact on both the municipality, which is Beaufort West in this case. And by the way, Chairperson, just as a reminder, this is the same principle that I've applied for all the subsequent applications that I will be bringing forward. And then taking into account the municipality's revenue and sustainability and the industries that it supplies, the summary of that exercise is in table 7 on page 158 of 435, Chair. And then coming to the allowable revenue, this is now table 5 on green stamp page 154 of 435. I've tabulated the budgeted figures that were submitted for the financial year 2024-25 when we were determining tariffs, which is captured in column 1 of table 5. And then the actual cost for the same period as defined in the audited reports is then represented in column 2 of that same table. Then in column 3.1 and 3.2, I determine the variances between those two periods, the budget period and the actual period in 24-25. And then the 3.2 represents the variance in a percentage form, whereas 3.1, column 3.1 represents that variance in rand values. And then for Beaufort West Municipality, the financial year 2024-25 variance between the budget and the actual total allowable revenue in column 3 reflects lower than planned expenditure and higher than anticipated other income offsets rather than regulatory adjustments. The municipality has therefore incorporated these outcomes into the forward-looking 2026-27 revenue requirement by you will see that further down column 8 and 9, they talk to a decrease in the total allowable revenue by 4%, which means that the municipality has recognized that it requires lesser allowable revenue than it had anticipated in 2024-2025. Then the financial year 2025-26 column is the baseline and represents the budget figures that are supplied that were supplied by the licensee, where the adjustment is made on a forward-looking basis for tariff determination for this period. And then this adjustment takes into account the inflation and ESCOM's bulk increases. And the municipality has incorporated a downward and outcome into the forward-looking 2026-27 revenue requirement. And this is also illustrative on the fact that the municipality is applying now for a tariff adjustment of 8%, which is lower than the previous period's 11.32%. Again, the cost items were verified against the audited reports to avoid any misstatements by the municipality. And on the operating costs, I can confirm that the only item classified under shared costs is the bad debts written off provision, because these costs represent an unavoidable collective cost of running the entire municipality rather than the direct costs of supplying electricity. So these bad debts then were shared among the divisions within the municipality. And then in terms of bulk purchases for the current financial year, the municipality is projecting an expenditure of 131.5 million, which accounts for 82% of total costs. And there are no NMD accidents, penalties, no interest charges included in the costs. And then for operating expenditure, the licensee seeks an OPEX of 26.4 million. And this represents about 15% of the total costs, which are adjusted downward from the previous year's 36.4 million.
Okay. I think you need to wrap up now, Ms. Botha.
I'm getting there. Thank you. Then in terms of surplus, the licensee is projecting a position of 6.9 million, and it equates to 4% return on the operational efficiencies. With all the considerations, therefore, Chairperson, I can conclude that In the current environment, it is appropriate to approve the Fort-West tariff application, and the associated recommendations are on green page 140 of 435. And I will read them into the record as follows. We recommend that the REC approves the tariffs that are based on the cost drivers as recommended in the tariff analysis section for implementation by the municipality with effect from the 1st of January 2026, and to also note the cost information submitted by the municipality. And we further request that the municipality to submit by the 31st of January 2027 an audited financial report accounting for all costs that have been noted to enable the regulator to perform its independent verification audit. And lastly, the municipality is required to submit a smart energy losses reduction plan on a quarterly basis, which commences on the 30th of September 2026 to enable the regulator to closely monitor these. And that brings me to the end of my talk, Chairperson. Thank you.
Thank you. Thank you, Ms. Potter. And I have allowed you to take as much as you have taken. And it's almost over 20 minutes. And in the next presentation, the 5 presentation you have, please try and minimize that because we're trying to manage time. We are due to finish at 5. So it is 10 minutes of presentation. Take the submission as having been read by members. And on that note, I'll move on to the members to just get issues of clarity, questions, and points of enhancements. I see there's a hand from Mr. Majola and Ms. Massetti and Mike. I don't know if we're voting, but I just thought I needed to take questions first. And if the hands are for questions, I'll take them. Mr. Majola, over to you.
Thank you, Chair. Thank you, Madam Porter. Indeed, my hand is for a question. Madam Porter, will appreciate that there's so many submissions that we have to go through. So we might have missed 1 or 2 things when we are reading your submission. But in all the other submissions that I've seen so far, they do state clearly that they are using the cost of supply methodology. And I tried to check on your, but I was just going quickly through your one. I couldn't find the statement where you're saying you're going to use the cost of supply, but probably it could be that I missed it. But nevertheless, looking at your table 5, it definitely looks like you are actually using the cost of supply. So in terms of the questions that I want to ask, being that, and it's really more one of the issues that has been coming out in terms of the cost of supply methodology. Just to check with you, because I can see that in your calculations, table 5, you have not incorporated CAPEX. In other words, CAPEX is not taken into consideration, is not included in your calculation of this revenue requirement. And so my question is that CAPEX inclusion, the fact that it's not included, can you confirm that it is actually based on that NESA framework for these municipal applications, that indeed, in terms of the NESA framework, CAPEX must be excluded if you are using the cost of supply methodology? Thank you.
Thank you, Mr. Majola. I'll proceed to Ms. Massetti. Over to you.
Thank you, Chairperson. Thank you, Ms. Potter. And thank you very much for raising a couple of things that we've been struggling with. And one of them being the issue of depreciation. And I think what I appreciate more is really the table 5. I just wish that this table 5 could be everywhere in all of the submissions, because it nicely deals with the questions that we've been asking when we start from 2024 being the audited figures. And then it does the reconciliation, and it deals also going all to 2025-26. Well, I said 2024-25 audited figures, and then 2025, which is still not audited, and then it comes to the budgeted for this year. Now, I just want to check, I do have questions here. I do see that you have actually dealt with capital expenditure, the CAPEX, what we call the CAPEX. You've got it under the cost drivers, and you've got a figure that you have put there in terms of 2024, which is what was budgeted in 2024. And you have also dealt with what was actually spent in 2024. Then in 2025, that became a variance, and how now is treated. Can you then say what the implications of that is in the business of the municipality, given the fact that Section 18.7 does require us to take into account the capital expenditure? So what does this mean in terms of the implications on the business of the municipality? Thanks for just being so transparent in that aspect, and also dealing with the underlying cost of this municipality. The second question that I would like to find out is on the clawback or give back, because I think it needs now to come out. Yes, I do take into account that the 2025-2026 figures have not yet been audited, because the year end is the 30th of June. But if you can deal with the variance that emerged from your reconciliation here, and speak to that variance in relation to the clawback for this municipality, because that's very important now that we have this. There is a line there where you deal with the total allowable revenue amount. Can you deal with that column on the 2024-25 budget to actual, that variance there of that total allowable revenue? I think it's a shortfall as I actually see it. Does that mean that that shortfall has been considered in 2026, 2027 as a shortfall on the revenue that is required by the municipality, and talks to the clawback or give back to the municipality? Then the last point that I have is in relation to the energy losses, which were quite high. If you look at 2024-2025, 2024-2025, you have provided a table. And let me just see, there's a table that you have provided. On that table, you are doing a scenario, a calculation on the scenario, indicating that if, for instance, that is table 4 under paragraph 3.5, which I appreciate. So if the table 4, paragraph 3.5 deals with what could happen, why did you use the 12% instead of a single digit? Maybe just to expand your scenario there, because what we should be aiming for is a single digit as opposed to the double digit, the 12%. If you can go down and maybe just expand on that to improve the revenue of the municipality. Thank you, Chairperson.
Thank you, Mr. Mk.
Thanks, Chairperson, and thanks to the presenter. From my side, just for 3 things. One, on table 3, I note that you for 2023-24, you talking to the approved and not the actuals. What were the actuals? maybe if one may understand. And then also to get to understand the issue of I heard you talking about bad debts shared among divisions. I just want to check how then aligned is that to the principle of ring fencing the energy or electricity divisions, revenue and expenses. And then I did not hear anything regarding consultations. If you can just enlighten us in terms of consultation by the municipality, responses thereto, and by our NERSA. I also would like to say that we have already put a principle that going forward, we would require proof of the consultation, not just the attendance, but how the municipalities have duly considered those inputs or comments put by stakeholders. So I take it that it was a slip of your tongue when you spoke of 8% tariff increase instead of, because what I'm seeing here is 8.5. I take it that it is 8.5. Consider this is a slip of your tongue, unless otherwise corrected. That is all from my side. Thank you.
Thank you, Mr. Kize. And I think also from my side, the issue that I didn't, or rather that I intend to raise in terms of the presentation, there was an indication that there were no comments in terms of the NERSA consultation process and no indication at all or mentioning of what has happened on the municipal side, which we have been emphasizing in terms of the past presentations that you've got, and also the percentage applied for was not very clear. And lastly, on the 12%, and I think the other presenters have been really taken to task to justify the 12%, and you have also done so. And you are not confirming as to where this 12% is emanating from. Is it based on the framework or not? And you've just mentioned it under table 4 without indicating as to where it is coming from, whether it's based on the framework or let me just say the basis of it is not clear. And also the issue of the methodology used. You are not stating as to what exactly is the methodology that you have considered that was coming from the applicant. I will stop there. I think the bulk account, I think you did respond to it. I had a question on that. And and I think the other one was raised by Mr. Majola on table 5 in terms of the capex, because in the last sitting, there was a lash out in terms of the fact that there's a need to consider capex as well as the OPEX costs. And in terms of your presentation, that is really not clarified. If you can cover that, it will be appreciated. Over to you. You do have time limitations to respond. Thanks. I think it's 2 minutes for you to respond to the questions of members. Over to you, Ms. Booth.
Okay, thank you, Chairperson. I'm not going to respond in any order, but I'll just respond as the questions come to mind. But in terms of the Mr. Majola's question on the methodology used, it is a cost plus methodology that has been used. And I think I did mention that. And the cost of supply, I did not explicitly speak to the cost of supply study because the tariff adjustment for 26-27 for Beaufort West is now based on the adjustment because they have already have an existing cost of supply study. So they did not resubmit a new cost of supply study. Hence, now the basis of the cost adjustments was just the tool the adjustment tool rather than the cost of supply study. And then moving to the actual increase, I think I stated at the beginning that the increase is 8.5% versus the one that was implemented last year at 11.32%. And then in terms of the CAPEX line item, the other question from Mr. Majola was on the depreciation. Again, in my presentation, I mentioned the full depreciation on the entire asset base, as well as the depreciation that is now being provisioned for the current year. Which is estimated at 4 million, but it's not disclosed on the table itself, but it's part of the operating costs. And then coming to the CAPEX implications, this particular municipality, Ms. Masetti, had plans to refurbish its infrastructure. So the reason why they had planned for that, and you would see that there was no actual expenditure, is because that those plans had now been delayed. And they will carry them forward in the subsequent years. So there were delayed capital projects that should have been taken care of by that capital expenditure provision. And then in terms of implications, obviously they are still going to be experiencing some technical loss issues because they have that those capital projects now delayed or on hold. And then when it comes to the variances on table 5, yes, you are correct. And as you can see, that let's just go to the table. Table 5. Okay, there you go. So in table 5, you can see that in column 1, there is a budget of 166.9 million rands. But then when you move on to column 2 of the same period, the actual costs that have been expended amount to 143.6 million, which effectively means that there has been an under expenditure. In a situation like this, then this would call for a clawback. Because it meant that the tariffs were set at a higher revenue, but then the actual spend on the revenue was lower. So in the event that the regulator has got a proper methodology to deal with such cases, then this would have been a clawback case. And then the same is true if the results were the opposite. And I think I've made there's a paragraph that I have jotted down in that respect. And I think it's on page 158 of 435, where I am just illustrating that currently there is no formal RCA mechanism for municipalities. And even though we recognize that there was an under expenditure from the municipality side, there is no, that does not necessarily mean that we will automatically recover those costs because we do not have the methodology on how to deal with that. And then I think in terms of energy losses, there was a question on energy losses and the fact that there is only a scenario on 12%. And yes, principally, the 12% is derived from the COS methodology. But then I think in my presentation, I did mention that in my final draft of the RFD, I have expanded that to 6% levels. And I did mention that the revenue that would be recovered in the event that the losses were kept at 6% would then be in the region of 10 million rands. I think I've covered some of the questions. If not, please feel free, Chairperson. Thank you.
Members, any follow-ups that you may have? Ms. Manseti, your hand is up. You may come.
Thank you, Chairperson. There's a follow-up on the capital expenditure, which I said I appreciated that she dealt with it thoroughly on table 5. What I asked specifically is that with the fact that the municipality did not use that amount and it is a variance now. So the fact that it has not used it, yes, you are. What I wanted to understand is just the implications on its business. Would it have any issue on, say, technical losses for the municipality or things like that? Because we just need to have an understanding of, yes, you say that there's delays on the refurbishment infrastructure project. But what is key for me, at least, is to understand the implications of that, given the fact that the municipality already has high energy losses. And I like the fact that you have separated technical losses as well as the energy-related losses. But I want to know what impact on the business. Thank you. Oh, by the way, Chairperson, that statement, Ms. Bota, because we gave them more, and there is a variance. So consumers have paid for something that the municipality budgeted. So it means they recovered more revenue, and they did not do what they said they were going to do. So it is important that, therefore, as we said, that clawback will be applied. And we've got audited figures from 2024, 2025. Surely that is that amount that they have not used. It must be an amount that must offset a portion of the revenue that the municipality requires for 2026, 2027. If that can be dealt with, Chair. Thank you.
Thank you, Ms. Botha. Please do address the issues raised by members as follow-ups. Over to you.
Thank you, Chair. Maybe I was not clear enough, but I did mention, ma'am, that due to the fact that the planned capital projects have now been delayed, the implication to the municipalities that they will continue experiencing the technical losses, because that was one of the reasons why they had earmarked those funds to progress with those capital projects. Yeah, I think I will stop it here because, as mentioned, yes, this is a scenario that that calls for a clawback in the event that the regulator has got a proper mechanism or methodology that would guide us on how we claw these additional funds back. Thanks.
Thank you. I'm not sure if you do answer the questions from the members in terms of that, to say that if there are capital projects that have been delayed, and therefore then how have you dealt with them in this particular application, and how you have dealt with them will guide the regulator as to whether there's a need for a clawback or not. Maybe it's just my understanding of your verbal presentation that is not clear as to whether these delays in capital projects that were considered previously, and how do we claw them back, or do we need to do a clawback or not? I'm just not getting a thorough response from you on that. But I see there's a hand as well from Mr. Majola. Mr. Majola, you may come and say.
Yeah, thank you, Chair, for the opportunity again. The issue that I just want to probe once again from Madam Bota is actually a question of saying, when you are calculating the revenue requirement, because I can see in table 5, you have calculated the revenue requirement, and you've got a number but I'm just questioning whether when calculating the revenue requirement, the issue of capex itself, not the depreciation, capex must be a part of the calculation or not. Why I'm saying this is because earlier on in one of the presentations, I think one of the presenters said capex is not part of the calculation of the revenue requirement if you are using a cost of supply. So that's just what I just wanted to check with you, that in calculating using the cost of supply methodology, does capex become a component of the calculation or not?
Thank you, Mr. Majola, for that. Ms. Potter, you may come in on the follow-up points from the members. But before you do that, I see there's a hand from Mr. Mkhize. Let me take Mr. Mkhize so that we answer that.
It's a small one, Chairperson. Maybe it escaped my ears. Whether we still stick to approved figures or just talk to the actual figures for 2023-24. Just didn't get a response to that.
Okay, noted. Ms. Potter?
Okay, the table 3, let's go to table 3. So the FY 2022-2023, it talks to what was approved in that period, that formed the basis now of the adjustments in 2024-25. So we have because that information now is extracted from the distribution forms, and there's a 2-year lag there. Therefore, it's important that in this current year, we are supposed to reflect the previous 2 years of municipalities' determinations. So that was approved during that period, but then it surfaces in this period because there's that 2-year lag with the deforms. And then coming back to Mr. Majola's question on the capex, yes, that is correct. The capex is dealt with via depreciation on the existing assets of the municipality. But in this case, and I think this is the only municipality that had capital project plans that it wanted to implement and made a provision for to expand within the 2024-25 time period. But then it has not done so because of some issues and some funding that did not come through that it also expected from the government as the supplement to that capital projects provision. And how we have dealt with it in 2025-26, you would have seen that in that same table 5, there is no longer that provision no longer surfaces in the subsequent years because it has now been removed from the revenue requirement until such time there's a requirement again for the municipality to implement its capital project plans. And then I think answering the question of clawback and under recovery and over recovery, again, the licensee had budgeted for a revenue upon which we had determined the tariffs in that period. But then the audited financials demonstrate that there was a lower expenditure than planned. So what that effectively means is that there has to be a clawback with that variance that is reflected in column 3.1. So it means that there's an underspend versus what was approved. and therefore that would call for a clawback. However, there is no definitive method currently that the regulator has as to how that shortfall would be recovered from the tariffs. I think, yeah, I'll stop here, Chairperson. Thanks.
No, that is fine. But I think for me, the question raised by Mr. Majola has not been adequately addressed in terms of CAPEX dealt with depreciation. I think you've talked about government issues and the fact that you have considered that due to government issues of 2025-26, and we are dealing with 2026-27 approvals. I don't want to dwell onto that, but I believe that question from Mr. Majola is not adequately addressed, but I see their hands from the members that are follow-ups. Let me allow them to come in. Ms. Masek.
Thank you very much, Chairperson. Thank you for the clarification, Ms. Botha. Ms. Botha, you are dealing with the issue of infrastructure, and you are quite correct about government coming in to fund some of the infrastructure. That is the correct position that you're making. When it comes to the surplus itself, the surplus gets related to refurbishment plans. And that's why we ask questions relating to the profit that is sufficient and the surplus that is sufficient, so that it can cover those issues of refurbishment. Now, what you're telling us is that that amount that was budgeted by the municipality for refurbishment project has not been utilized. That is proper, and in terms of you just dealing with the distinction of what government can do in supporting the infrastructure financing part of the municipality, and the tariffs catering for the repairs and refurbishments. You are quite correct in drawing that distinction. However, if you can just teach us in terms of the accounting principles and also the law in relation to this cost plus methodology, as well as the rate of return, whether in our assessment and taking decisions, we must not consider the asset value or the CAPEX, whether we must not consider it simply because it is a cost plus. I think that is the aspect that you must be short and straight to the point and deal with it once and for all. And I made mention of section 18.7, which calls for OPEX as well as CAPEX. And you have dealt with that. All that you need to do is to clarify, how do we deal with depreciation when we can't consider CAPEX or the asset value? Can you just deal with that aspect? Number two, that issue of the clawback or whatever the give back, to the extent that the municipality did not do what it said it was going to do and has taken money from consumers through the tariff, should that amount not be offset on the 2026-2027? What's wrong with offsetting that amount that it did not use, which it has taken from the consumers? Those are the two things for me. Thank you.
Mr. Mkhize.
Thanks, Chairperson. I think there's an inordinate amount of time that you are taking on this submission, which I think it's a matter that also emanates from a point of standardization. I think in terms of how these are presented, issue of standardization is very important, so that sometimes the matters are just convoluted by way of just sheer presentation and articulation, which I think the head of department and EM and everyone are going to look at it from just aligning things accordingly. Because we're also going back to the issues of CAPEX and all of that. We've already indicated that there's an expression of the capital side of things by way of the depreciation when one looks at the cost plus methodology. And that even the issues of the 12%, we've already articulated on these things by way of saying that they come from the framework, the COS framework. And colleagues, I'm just concerned from a point of view of the time that we were taking on it. With also some of the things that we were reopening previous discussions on the same matter. I would appeal that we move towards maybe the decision, noting that the need for really standardization. If you look at it, the way you have dealt with all the rest, there's just a difference here in terms of how issues are presented. Let me leave it at that, Chairperson, that delaying your meeting. Thank you.
Thank you very much, Mr. Mkhize. And I also wanted to give sufficient time on this one because I think the presenter was presenting this for the first time, and also noting the fact that whatever issues that are raised by the members on this one would have to be considered in the other presentation. And I think we have tried with the 2 pages that the other presenter did to ensure that issues that were raised by members needed to be covered. And even on this one from my side, I did not hear the presenter talking about whether the municipality have consulted and what were the comments and if there were any, how they were dealt with. And I didn't really raise this, and there's issues of CAPEX consideration in relation to the methodology which are not adequately addressed. And I think for us to try and direct the presenter to respond to them at this stage, it's just going to be delaying the meeting. And I do agree with your point to say that there's a need for standardization of the presentation. And all issues that have been raised in the previous presentation have been shared with the team. And I think from my side, I even wrote them to the team to say that they must cover them. And that was done with the 2 pages or supplementary 2 pages that were presented in the previous meeting. And the issue of depreciation when looking at the cost plus methodology as well not being answered really adequately. But I would want to then take these as points of enhancements in terms of what the members have made, and try and move on to see if we can just consider the recommendations as have been done with those enhancements that the standardization issue needs to be done. The depreciation, when it's being looked at, it needs to be aligned to the methodology used, which is the cost plus methodology, and all the other issues that were raised in the previous presentation, that they be addressed. That we're raising this as points from the members that they were not adequately addressed on this, but based on the recommendations that are on page 140, I would want to see if members are happy to recommend them with the enhancements that have been raised in relation to the CAPEX, and as well as I think there was an issue of government position that was raised, and consultation processes. A standardization of the presentation, and as well as how we deal with the presentation with the issue of depreciation. It is covered in all of these are covered in the presentation, but they are not coming out in a clear manner such that members are able to engage on them or to say they're happy with what has been said. So members, on that note, the recommendations are on 140. with those enhancements that you have raised in relation to this particular presentation. Can I get an indication that you do support what is being recommended? Maybe, Pumla, from your side, if I may get an indication that it's an issue that it is, was it 8%? Just reading. Okay, maybe I did not note the percentage properly that was requested by the licensing. Members, on that note, with the enhancements that have been really put forward by the members, can I get an indication that you support what is being recommended, and with a request that the RFD be enhanced with your input? Thank you, Mr. Mkize and Mr. Majola are also support. Don't see a hand from Ms. Musset.
Hello, mine chairperson, as I support the recommendations, the issues are there. 5.2 deals with the public consultation, and even in the presentation, it was mentioned. So it is dealt with the 5.2 on the actual document. And the depreciation and the capex, they are also dealt with in terms of the methodology. She explained it is there on table 5, and it has to be dealt with. She did explain that. So if members don't understand something that we asked for, that
Ms.
asset
Musset,
value.
you are
Can I finish,
responding on
Chairperson? You
behalf
can
of the
come in.
present.
Can I just
Okay,
finish,
thank you.
Chairperson? Because I'm explaining my part of the decision so that mine is not approving subject to those specific enhancements. So I'm just clarifying my support to say that that information is actually there, and that the information on depreciation and the asset value is the fundamental issue of depreciation, irrespective of the methodology. And that's what I heard from the clarification. That's all that I wanted to clarify what I'm approving, Chair. Thank you.
Okay, noted. However, on 5.2, the comments are not specific, and I think we have really in the past application to say that on public comments, we need to get comments that were based on NESA's publication, and as well as comments that were based on municipal publication. And noting the fact that the municipal public consultation process is within the control of the municipalities. And that was not responded to in terms of saying the municipality received so many comments and that they have been addressed. 5.2 does not address that, and 5.2 seems to be addressing the comments on the NESA side. And that's the point that I just wanted to highlight on that public participation process. Mr. Mkize, your hand was up so that we wrap up on
No,
this.
I'm fine. I'm saying I'm just looking at the interest of time that
Yes.
where there are enhancements and they are already provided, even if they are already provided, it will be a question of phrasing them in a manner that is understandable. I think, yeah, let's take it in that, with the spirit, and then proceed, please, because the decision has already been taken. Thank you.
Thank you. And the recommendations are supported, Ms. Botha, with those enhancements from the members as I have read them out. We then move on to the next application on Cedarbek Municipality. Ms. Mabinya, over to you, ma'am.
Thank you, Chairperson. Good afternoon to you, members, colleagues, and the members of the public. Chairperson, Cedarbek is situated in the Western Cape, and they are applying for 9.01 increase. The application before us was approved by the council, and the municipality conducted its own public participation process. No comments were received from the municipality in terms of their own consultation process. On our side as NERSA, we've also published the application, and no stakeholder comments were received by the closing date. And the municipality has an existing cost of supply, and they have applied a cost plus methodology, and the cost adjustment tool was used for the 2026-27 tariff period, and the underlying cost taken into account OPEX, carpet related in terms of depreciation. Chairperson, the asset value of 182 million and the depreciation for 24-25 were extracted from the due forms and verified against the audited financial statements. It's also important to note that, Chairperson, this municipality is one of those good performing municipalities as indicated in Table 3 on performance indicators on page 179, where the municipality has recorded a surplus of 15.96 and energy losses of 5.77. And to ensure that the surplus is not overstated in line with the EPP policy position 1, the surplus was tested against key risk factors. First one being the energy losses, the consideration of customer affordability that may lead to non-payment, when non-payment turns into debt risk when the municipality can no longer collect. And then these are linked, Chairperson, to the financial sustainability of the municipality. And therefore, Chairperson, the 18% surplus is within the 10 to 20% cost of supply framework range and is a risk-based profit margin as required by policy position 1 of the EPP. And as indicated, Chairperson, that this municipality is performing well and we are therefore compensating them in that basis. And in terms of the ESCOM account, they are up to date and there is no NMD exceedance. And then the issue about cross-subsidy, the large customers are subsidizing the small customers, and therefore there is an immediate need for the municipality to develop that cross-subsidization framework to address the issue of cross-subsidy in a fair and a transparent manner. And therefore, the municipality is proposing a uniform tariff increase of 9.01%. And then, Chairperson, I'd like you to take you to the recommendations on page 170, that the REC is requested to approve the tariffs that are based on the cost of supply report for implementation on 1 July 2026. To note the cost of supply report submitted by this municipality, as well as that the municipality will be requested to submit a report accounting for all the costs that have been noted in its cost of supply study to allow NERSA to perform its independent verification audit process. Thank you, Chairperson.
Thank you, Ms. Mapenya. Members, any questions, issues of clarity or points of enhancements that you may have on this particular application? Please do raise your hand so that you can be recognized to make your input. Ms. Mapenya, I don't see any hand from the members, but I think from my side, I may have missed what you have said, but the important point was on the public consultation process in terms of whether NERSA did get comments or not, and also on the municipal submission to yourselves as to whether they've gotten any public comments and how they have dealt with those. If you may come in on that point, that's the only point that I have for you. Over to you, ma'am.
Thank you, Chairperson. Yes.
Before you go ahead, Mr. Mkize's hand was up. Mr. Mkize, do you want to come in? Oh, it was a lingering hand. Okay.
No,
proceed,
you covered
Ms.
me, Chair.
Okay, Ms. Mapenya, just go ahead, ma'am. Apologies for interrupting you.
Thanks, Chairperson. No, both NERSA and the municipality have consulted. The municipality has not submitted any comments that they have received on their own consultation. And also on our side as NERSA, there were no stakeholder stakeholder comments received for this application by the closing date of 21 April. Thank you, Chairperson.
Thank you, Ms. Mapenya. On that note, members, Cedarbek Municipality, the recommendations have been read into the record. They are on page 170. Any comments, or maybe by show of hand, because I didn't see any comments from the members, that you approve the recommendations as stated in page 170. Thank you, Ms. Maseti, Mr. Mkize. I do support. Babu Majola.
Okay.
Thank you, Mr. Majola. Ms. Maseti, your mic was open. I don't know whether you're voting or you wanted to read something.
Yes, Chairperson. Chairperson, all that I wanted to raise is on that table. There is on the calculations, there is a point that says that the increase that is required, having done all of the calculation cost drivers, is 14 point something %. That's what I wanted to raise and find out now. How does this, reconcile with the 9% that has been requested? Thank you, Chairperson. I will support based on that.
The table number, ma'am, I've missed it. I think you didn't mention it.
Table 4, it has all of the calculations,
Table
the cost
4.
of drivers and all of that. Yes, it has a 14 point something %. Just going to it, but it is over 14%. It says, based on all of these costs and everything, the increase that is required is 14 point something %. Yet we've got 9%. Just wanted to check that. What does the implications of that, and what does it mean against that 9%? Thanks, Chair. I'm approving based on that.
All right. Ms. Mapenya, the 14.8, I think that's what is being referred to. If you can explain it so that we can reconfirm the voting.
Thank you, Chairperson. The 14% that Ms. Masset is referring to, it's the increase in terms of the cost, but the municipality has decided to apply a uniform 9.09% in line with the ERTA that has been approved for ESCOM. So the tariffs are escalating by a 9.01%. I hope I've clarified, Chairperson. Thanks.
Thank you, Madam. Ms. Maseti, are you addressed?
I will leave it at that, Chairperson, but we must just take care of that aspect because it shows a significant shortfall. And if one looks at the percentage of the surplus, just to flag those issues, Chairperson.
Okay.
Thank you.
Thank you, ma'am. I think in the RFD, Ms. Mapenya, let's just highlight that point. Mr. Mkize?
No, just stating that it would help, please, management, if you may, and presenters, if you can just help when you respond to point us to specific areas. For example, if you had made them were to point at 4.27 and then be able to then justify, and it makes it easier. Because that is, I was thinking of the same question, actually, that's why. And then when I look at 4.27, because I had seen that figure, and then you can build on what you already have. It helps. I mean, with the other presenters, again, the issue of consultations. Let's not take a lot of time by just presenting in a manner that has already been established, please.
Thank you, Mr. Mkize. And I think, as I said, in the 2 pages that the previous submissions we had considered, there were 2 pages. And I think from my side, I did make notes on what were the points that were raised so that we speed up the process. But I think on this ones, these may have been missed or covered in a different manner. If they're covered, please do direct us to those. So that we don't repeat things that were raised in the previous submission. Mr. Majola, your hand is up. Or was it for voting? Okay.
Sorry, it was for voting. Apologies.
Okay, in terms of the voting on this one, which is Cederburg Municipality, I think I did see a hand from Mr. Mkize, Ms. Masiti, and yourself, Ms. Majola, and I also support. I do confirm for the record that those that have read out have voted for the support of the recommendations under the Cederburg Municipality without really asking members to really proceed and again vote. And we then go on to the third one, Centelec SOC. Mr. Ralufwe, please, can we manage the time? I think, yeah, it's just we're taking a lot of time. Let's not have a repetition of what has already been raised by members. Rather, in your presentation, highlight if you have covered all the issues that members have raised so that we allow them to ask questions if what they have raised previously is not covered, and we just deal with it. Over to you. Take the submission as having been read. And we do know the fact that Centelec was really dealing with, I think, 3 municipalities in Mangaung. I may be wrong. If I recall, it was Mohokare, Kopanung, and a lady, and that amalgamation, we do know of it. And now they are coming up on Mangaung. Let's just focus on Mangaung because the other licensees, Mohokare and Kopanung, are dealt with separately. So just focus on that and take us through your submission. Tate Rolufe, over to you with Centelec.
Thank you, Chairperson, and thank you for your opening statement. Centelec, excuse me, Centelec, it's indeed supplying on behalf of Mangaung Metro. So Centelec, Chairperson, is using an existing cost of supply, and upon its application, it has indicated that it has consulted its customers, and indeed we received a proof of that. And NERSA on our side as well, the consultation was done. And Chairperson, Centelec is supplying 154,725 customers in Mangaung, and with indigence of 40,373, which is granting 50 free basic electricity, 50 kilowatts. And in terms of financial performance, Chairperson, Centelec has recorded a deficit of 26% in 2023-24 financial year, and has slightly improved despite it being a deficit in 24-25 to minus 15.58%. And also the energy losses have slightly increased with a decimal digit, Chairperson, and where the energy losses are in total are actually amounting to 396.8 million. Going onwards, Chairperson, Centelec has sent us the cost adjustment, requesting for a revenue requirement of 5.2 billion, and then also it has adjusted its cost mainly on CPI, and also excuse me, and also the bulk purchases on the ERTA number, which is 9.06%. There wasn't slight adjustments which were done, Chairperson. The adjustments were just 79,270, and the costs were verified, especially with the deform. And upon its application, Centelec tabled an application of 9.9%, and which we support, it being in line with the bulk purchases emanating from the ERTA. And in terms of the surplus, Chairperson, we have engaged Centelec upon the surplus to say their surplus is low, and we know what is due from. It is due to the higher cost base, or rather its expenditure management, because SENCLEC is mainly depending on consultants. That is one of the main line items or other components that is ballooning the cost base. So, Chairperson, in terms of cross-subsidization, SENCLEC HomeFlex single phase is subsidizing, as well as bulk resale 2, as well as bulk resale 3, and ElecFlex 1 up to 3. They are subsidizing other customers. So with that, Chairperson, I would like to throw you, or rather, Chairperson, when we go to the schedule of tariffs, yes, SENCLEC has applied for 9.9%, and as such, we after our verification, we found that yes, we recommend for a 9.9% increase. And Chairperson, I would like to draw you to the recommendations from emanating from this submission. We recommend that the tariffs are based on the cost of supply, supported by the cost adjustment, and are approved as recommended in the tariff analysis section for implementation